Okay, well, this morning we had the RBI Governor, Shakti Kanta Das, speaking on the interest rate policy, which has been kept at 4%. But so many other things that were marked by the governor. He forecast that inflation for FY22 will be 5%, and he's ready to maintain an accommodative stance, which means that interest rates will continue to stay a tad bit on the lower side. Further, he speaks about GSAP, which is essentially a government securities buying program. This is something that will help stabilize the yield curve and will in turn have an impact on debt fund holders as well. There's a GSAP 2.0 now, after GSAP 1.0 announced in April. Now there's GSAP 2.0 for the second quarter of fiscal year 2022. He also speaks about liquidity. He speaks about so many other factors really that would aid the economy and come out of this growth phase. But largely, when the RBI governor speaks, there's a lot of momentum in the yield markets, in the fixed income market. So we'll understand exactly how this has, how the commentary from the RBI governor will move your debt markets going forward. What should debt fund holders look out for? And, given the current macroeconomic scenario, what's the best mix of debt fund categories to hold? I'm joined now by Mahendra Jajoo, the CIO of Fixed Income with Mirae Asset Management India. Mr. Jajoo, thank you so much for taking out time and joining us today on the Money Show. So, from a debt fund holder's perspective, what, according to you, stood out from this morning's RBI governor's speech?
I think there were two very clear messages. One is that the Reserve Bank is committed to support the growth and the recovery in the economy, because as we all know that over the last 1 year, COVID-related lockdowns and other disruptions have caused a dip in the economic growth. And the Reserve Bank is committed to maintain an accommodative monetary policy, which will help in supporting the economic recovery as and when the lockdowns are lifted. The second is that the macro fundamentals of our country remain strong. While there is a temporary dip and disruption, the long-term prospects for the country remain as good. We are beginning to get back the FBI flows. The markets on the equity side are at near all-time high. So that, I think, is an indication that the investors should remain confident and optimistic. They should continue to stick to fixed income investments. Right now, there may be some volatility in the market because of the large government bond supply and some rise in the global bond yields, but these are the market cycles. If they remain invested for the long term, I'm sure that they will be generating good returns for their investments.
Let's talk about some of the announcements. One of them was GSAP 2.0, which has been announced for, I think, a little over 1 lakh crore rupees for Q2. To start with, in April when GSAP 1 was announced, which essentially entails buying government securities, which in turn, of course, has an impact on the yield curve. How did it impact the yield curve and debt funds as well? And how do you expect GSAP 2 to do?
So one of the biggest concern of the market players right now is the large supply of the bonds. As we know that in the last year, the fiscal deficit was close to 9.5% of the GDP, and in the current year also, the fiscal deficit is expected to be at around 6.8% of the GDP. That is largely to meet the one-time exceptional expenditure because of the COVID-related disruptions. And this government securities acquisition program by the Reserve Bank lends an helping hand in addressing the concern of the large supplies. So for the current year, the total borrowing program is about 9.5 lakh crore, and then there is another about 1.5 lakh crore which will come because of the shortfall in the revenue of the state governments. So about 11 lakh crores of total borrowing, out of which the Reserve Bank at this pace, together with the OMOs, etc., will end up buying somewhere close to 5 lakh crore. So you have just about 6.5 to 7 lakh crores of borrowing to be supported or absorbed by the market. So the government securities acquisition program is helping in keeping the interest rates low and that will definitely help in the economic recovery process. That will also mean that the affordability of the retail people in terms of the housing, in terms of the other consumer durables will continue to be pretty low, pretty high. So it will help develop the markets for these products, for housing, for the consumer durables and other consumption expenditure. So that will also mean the revenue support for the small and medium traders and companies. So all in all, I think this is one of the key measures by the Reserve Bank, which is going to help the economy right from the bottom, from the poorest to the uh, larger corporations. So it's a very, very impactful and positive measure that the Reserve Bank has taken.
All right. Let's talk then about inflation. It was, I think, on all of our minds for the last couple of weeks, months, globally as well. In a country like America, where inflation really hasn't been much of a threat, there too, people have been talking about it. Though, of course, right now it has eased a little bit. That's what the governor has said. But it's still a threat. So how do you see inflation impacting returns in different debt funds? And also, how can debt fund holders tackle the inflation threat?
See, right now the inflation is at 4.29%, which is not very high. The Reserve Bank's target range is 4 to 6%. Even if you assume that the inflation is going to inch somewhat higher in the coming months, we are looking at around 5% for the month in June and maybe get closer to 5.5% sometimes later. The Reserve Bank has given an average inflation forecast of 5.1 for the FY22, of which the highest number is about 5.5%. So I think 5 to 5.5% inflation is not such a undesirable scenario in a growing economy, and at a time when the global commodity prices have been shooting through the roof. I was just reading in the morning that in the last 12 months, the food prices globally have risen at the fastest pace in the last one decade. So given the broader picture, I think the inflation condition in India remains pretty benign. There is a lot of concern about the inflation hitting later on the higher side, but at this point, those fears have not been proven right. So there is too much concern in the mind of the people that the inflation is going to shoot up, but there isn't any evidence right now to believe that it will happen. So and then as and when the inflation does go up on a sustainable basis, the Reserve Bank has said that it will be monitoring the inflationary situation, and therefore we should believe that at the appropriate time the Reserve Bank will take the right measures, tighten policy, increase interest rates, which will then mean that the retail investors can continue to earn positive real interest rates. So in the overall scheme of things, I don't think that inflation is such a big issue right now. People should not worry too much about it and focus on the recovery in the economy, which is the most important point right now.
Well, another interesting point that the governor flagged off is that he expects interest rates on commercial papers, 91-day treasury bills and CDs to remain low and range bound. A lot of debt funds, especially on the shorter end, do invest and buy these papers. So what does this indicate for debt funds which invest in these papers? I mean, are we perhaps looking at a lower interest rate environment for these shorter duration funds?
See, right now we are in a low interest rate environment where, let's say, the commercial papers, etc., are trading somewhere around 3.5%, which means that the liquid funds are giving a return of somewhere in the 3/4 to 3.5% band. The low duration funds are giving returns in the region of 3.75 to 4%, and for the last 3 to 6 months, the longer duration products have given somewhere close to 4.5 kind of a return. Now that return in absolute terms sounds low, but then if you look at the bank fixed deposits, they are in the region of 2.5 to 3% for the corresponding investment period. The markets move in a cycle. If you just go back to 6 months back, people who had remained invested for 3 years or longer were getting close to double-digit returns. So this is a kind of adjustment period which is happening in the bond markets. The interest rates have come very low and they're likely to remain low, and therefore it is possible that for the next 1 year the debt fund returns will also remain in this range. But then this has to be looked in relation to and compared with what are the other alternate options. So for example, if you look at the housing market, the real estate prices have been stagnant for the last 5 years, or they have come down in most cases. The gold prices are now nearly flat for over a year. So this is happening across the asset classes. This is the current environment. But then we know that the markets are cyclical in nature. Over the next 2 years or 3 years, again, there will be many events which will cause the interest rates to go up and then again come down. That's where the investors will get opportunity. So there are two key points which I am trying to make. One is that the market is what it is, so we have to accept the returns that the markets are offering within the boundary of what are the alternate options. And then over a complete interest rate cycle, investors will get their opportunity and they will end up with good returns in the long term.
Okay. Another point was that given the fact that we are in this low interest rate environment, India Inc. has been issuing more and more corporate bonds and getting into fundraising mode. Is this a point worth noting for corporate bond fund holders and fund investors?
The governor said is that because of the active management of the environment by the Reserve Bank, even during such a time of crisis, the credit requirement of the corporate sector was easily met and the interest rates were low, so the corporate borrowed a lot of money from the bond market. Now that is a good development because it was felt at all times that the corporates were too dependent on the banking system. We see that on the one hand, the corporates have raised record amount of money from the capital markets, but the bank credit growth is just about 5% for the last year. And there too, the larger component has come from the non-industrial sector like agri sector and so on. So that shows that the active management of the environment on a constructive basis by the central bank has led to the development of the corporate bond market at a faster pace than we have experienced in the recent years. But for the corporate sector as a whole, I think the overall debt levels have come down. If you look at the large corporates in particular, if you look at the top 50 corporates in India, each of them have mostly reduced their debt, right from Tata Steel to Ultratech Cement, some of the larger names. There is a steep deleveraging that is happening. So this is very good again for the corporate balance sheet of the country. Therefore, I think from where I see it, there is all-round positive development here. Now, concern obviously is that there are a lot of NPAs and other stress assets which might have been subdued for now because of the restructuring that the system has allowed and because of the credit guarantee schemes that the government has operated to deal with the COVID situation. And once the COVID situation is behind us, then we will know exactly what kind of the NPAs are there in the system. But the good part is that during this time, most of the NBFCs and banks have raised fresh capital, and therefore even if there is a slightly higher level of NPAs in the coming quarters, I believe they have adequate capital to deal with it, and therefore we are unlikely to see the kind of credit crisis that we saw in the last 3 years where there were a series of defaults. So all in all, I think it's a positive development, one notch up in terms of the development of the corporate bond market. That is how I feel about it. This is opening up the market access to a lot of second tier corporates also, which is the most positive part of this whole process.
I just want to address the AMFI data as well. Last month we saw massive inflows in debt funds, particularly the liquid funds, the money market funds, and this has come in after 3 to 4 months of either negative or very little net inflows. What do you think has triggered it? Is it largely just corporate action?
See, the system is flush with liquidity. Last year, we got $100 billion of forex flow. So the governor mentioned today that possibly the forex reserves of the country has hit close to $600 billion. That was at around $500 billion last year. So that kind of liquidity has come into the system. Because of the business slowdown, the corporate credit pickup has been poor, as we just discussed. So there is so much of excess liquidity in the system, which is now trying to find investment avenues. The debt funds are offering one of the best risk and return profile of all the available options to the investors, especially within the debt space. And therefore, it is natural that so much more investment is coming back. What is especially heartening for us is that last year there was a lot of there were a lot of events which possibly could have upset some of the investors, and there was a lot of talk that people may lose confidence in debt mutual funds and so on. But if you look at the last 1 year, people have reimposed their faith in debt mutual funds. We now have to appreciate that there was a very small section of the debt mutual funds where there was a bit of pocket of problem, but largely the debt mutual funds have operated to the benefit of the investors at large. And that is the reinforcement that we are getting because of the record flow of money that is coming into the debt mutual funds. Debt mutual funds will continue to remain a very attractive option for the investors, especially those who are looking at the fixed income. And therefore, a combination of the expression of the confidence once again in debt mutual funds and the excess liquidity that we have in the system without any meaningful viable option. Because if you look at real estate, gold, currency, there isn't any kind of a decent return profile at this point in time. The asset markets remain lackluster, and therefore we are seeing this kind of a huge attention to the debt side right now.
Okay, now I just want to look at the current macroeconomic environment, the statements as well from the RBI governor, and just taking all of this into consideration, what's your view on interest rates? And based on that, which are the best mix of debt fund categories that retail investors should hold right now?
Yeah, this year there are two factors at play. One is that the interest rates have already come down. So for the interest rates to come down from the current levels, the scope is very limited. Therefore, I don't think that we will see the same kind of returns in the current year in those funds, at least for not in the next 6 to 9 months, but over a three-year or longer investment horizon, I believe the same return profile will be replicated. At this point, people want a bit of a higher safety because there is a lot of apprehension in the mind of people that because there is a large government borrowing program, the interest rates may go up. A lot of people feel that the Reserve Bank, through its highly accommodative policy, is possibly keeping the interest rates low, but the fundamentals deserve higher interest rate level. There is concern about inflation in the global markets. As you know, that the US yields have gone up from 0.6 to around 1.6% in the last 6 months. So there is a lot of, I think, confusion, and perhaps the market is a bit short of confidence on whether these interest rates can be maintained, and therefore the longer end of the yield curve is very, very stagnant and somewhat range bound. So people are looking at the safety of the short-end funds, which is possibly the right approach. So therefore, we are seeing a higher amount of interest right now in the low duration category, in the liquid funds, and so on. This is likely to continue until there is more clarity about which way the interest rates are going. When the interest rates can find their own level purely dependent on market forces and without the strong interventions from the Reserve Bank, that is the time perhaps the long duration funds will find some attraction again.
Now, in personal finance parlance, when you invest your money in mutual funds, you should have a certain financial goal in your mind. So how should investors, depending on what their goal is, it could be maybe buying a house in the next 3-4 years, or a car, or paying for an education in the next 4 to 5 years, depending on all of these different financial goals, how should they pick and choose across different debt fund categories?
See, there are two basic fundamentals about goal-based investing. First is that the investors have to expect, or have to understand what is their target investment value. What is their, target investment value when the investment horizon is over, and then they have to look at the expected rate of return, and then on that basis they have to make allocation. Then investors have to make allocation to fixed income in line with the conventional asset allocation theory, because they can't put all their eggs in one basket. So first, the investor has to decide what portion of their money they can invest or they want to invest in the fixed income funds. And then they have to look at their investment horizon. Let's say if someone is looking for his son's education 10 years down the line, in that case, I don't think for him there is too much merit in analyzing the current interest rate environment and what happens in the next 3 months or what RBI is doing today, because he is going to need that money after 10 years when we will possibly have 3 or 4 interest rate cycles play out during that period. So for him, the simple solution is to invest in the long-term bond funds where he can maximize his return. But if his investment horizon is, let's say, just 1 year or 6 months, say his son is to go abroad for higher studies next year, then he cannot take that kind of a risk return profile and then possibly look at a fund which has a lesser volatility. And therefore, what kind of fund one can choose is going to be a function of what is his target, what is his investment horizon, and what is his risk appetite. It will also be a function of what kind of other exposure he has. For example, if someone has invested 70% of his portfolio into equities to get higher return, then he will look at a relatively safer bond fund. If he has invested only 40% in equity, then his risk appetite on the equity, on the fixed income side will be a little bit higher. But largely, I think it should be a function of what is their investment horizon and what is the expected rate of return. In that combination, if you look at the debt funds, the liquid funds and the ultra short-term duration funds are at the shorter end, which give you higher relative safety in terms of capital and lesser volatility. But obviously, the returns on those funds tend to be slightly lower than the longer duration funds. And the longer duration funds have a slightly higher volatility, but they, in the long term, have at least historically given significantly higher returns than the liquid funds. So if the investor has a longer investment horizon, obviously his choice would be the bond fund. If he has a shorter investment horizon, then it should be the liquid fund or the ultra short-term fund or similar.
Okay, Mr. Jajoo, we leave it at that. Thank you so much for joining us today, helping us understand, make sense of the RBI governor's speech, the announcements, the impact on yield curves and thus debt funds as well.